questions coming up. So we are back live talking about toxic fuels. Okay, go back to it, Tom. Thank you.
I don't know what was on TV and what wasn't, but I'll start from talking about VPIC. During the spin-off from the Treasurer's Office, they also expanded the membership of VPIC, including a member of the School Boards Association, as well as the League of Cities and Towns. And so we have currently 9 members now, 12 members and then some non-voting members, as well as the Treasurer's Office has a treasurer as an appointed position. And so we have a real robust group of people. The governor appoints 3, each of the underlying pension boards appoint 2, one of which each are voting, one's non-voting. And I know in our original presentation, we put a chart that you can see if you have any questions on that. The issue of divestment has come up many years. I know we talked about it last year. We actually had a bill in language last year that we agreed on to a large extent because we felt it would be beneficial both for VPIC as well as the state. We share a lot of concerns, and we integrate ESG as well as carbon issues in our portfolio. We have a carbon decarbonization policy that we initiated this past year, mainly for that effect. We integrate it in our manager process. We've turned over pretty much every one of our managers since 2017 with that as a lens in looking at the manager selection. And so I view us as partners in this process, and the concern I would have and VPIC would have in regards to legislation. Legislation becomes sort of a hard stop, and there can be unintended consequences of that legislation. And the concerns with that really are Vermont specific, and they come back to some of the priorities that we have in regards to our staffing levels and our ability to really do a lot in a short amount of time. Reasons not to divest, and there are a number, but Vermont specific, I'll start with the Vermont specific ones, then I'll go into more general ones. There's really 2 issues, particularly with S42 as it's written, that would impact the VPIC portfolio significantly. And I bring this up, and I have it in my presentation, but I'm not going to go through each of these every page. But I'll hit the highlights. The first is, since 2017, we've really indexed a significant amount of the portfolio. And so we have a tremendous amount of assets, maybe 3-4 billion of the $5-6 billion portfolio is invested in index funds. So we don't manage individual stocks to a large extent. Of our direct holdings, we probably have about $40 million in fossil fuel related stocks. That translates into about 0.7% in the portfolio of our direct holdings. Now, if you add in the index funds, there's going to be some more, just because as part of an index, there will be some energy-related stocks as part of that. For the benefit, the biggest benefit of indexing is that we pay 2 basis points to invest in those index funds. It's a significant cost savings. We pay 35% less in fees than we did back in 2017 when I started. And that we pay less now than what we did back in 2017. And at that point, we had only $3 billion in assets. So you can see what VPIC has really done over the past 5 years to really benefit the state of Vermont. And
so wait, can you just remind us what the current assets are? Was
about 5.6
yeah.
And we were about 3.5 billion back in 2016, 2017 when I started. We paid about 28 million all in costs probably at that point. We're probably about 24 million all in costs right now. So we're less than what we were with almost twice the assets. So you can see there's been a huge turnaround and a real focus on investment savings and investment costs. The second aspect of indexing is it really gives us a real diversified portfolio mix that helps lessen the investment volatility. And so we rely on that as our core portion of our portfolio. Part of the 2018 study with divestment, one of the charges was to create a low carbon index fund and offer that to the general population through BlackRock. We've done that, and we've achieved that with over $250 million of our index funds. So we are working towards the process of decarbonizing the portfolio. So I just want to be clear, VPIC is in agreement with goals. I think we differ in regards to the strategy of how to implement that. The costs associated with not going the index route are tremendous. We would not be able to do it with 3 people. We would probably have to have 4 or 5, maybe more people if we were to do personalized indexing or stock selection strategies. And so for that, a lion's share of our portfolio, I would feel in any act that you consider be excluded. I think you really need to exclude index funds from the mix because I think it would put Vermont at a significant disadvantage in investing if we weren't able to access traditional indexing products. As they come in, we're more than willing to look at them if there are alternatives. But at this point, the carbon-free index funds that we look at are twice the price, and they have more volatility. And so from a fiduciary point of view, VPIC does not feel that they're in line with a fiduciary standard for VPIC's portfolio. That's the first concern VPIC would have in regards to divestment or mandating divestment. And so from that perspective, we really would respectfully request that you exclude indexing assets or commingled funds. You could call them one or the other, but commingled funds, yeah, that would be referenced. The second aspect of Act 742 is the impact it would have on our private equity portfolio. Our private equity portfolio, we've been rolling out since 2016, 2017. Eric has been instrumental in this, and he can talk to the effect of what we've done and how we've grown the portfolio. You really have to look at that from a success point of view. We've outperformed the comparable index by 1,000 basis points. That's 10 full percentage points in our portfolio. We rely on that in terms of setting the actuarial rate of return every year. Right now, the actuarial rate of return is 7%. There's been debate whether or not we should lower that just because of market conditions. And we have resisted that because of our private equity piece. We really feel this divestment bill would, one, prevent us from getting into long-term contracts with the top tier private equity. You don't want to be in private equity unless you feel you can be in the top tier. There's no reason in tying up your money if you can't do that. If we cannot access the private equity, private debt markets the way we're doing right now because of some restrictions, it's more of an inadvertent effect of legislation. I just caution you, if you are looking for better language, excluding our private markets would be another thing that I would respectfully ask for.
What's left
Well,
after you exclude the indexes and the private market?
we have about $1 billion in direct holdings right now, where we hold about $40 million in fossil fuels.
So that's where the 40 million are?
Yeah, that's where the 40 million is.
So
And
what are you calling that group?
it's direct holdings.
Right.
And I had Katie and Eric and Andy put together a list of what we currently hold. At least this was as of December 30th. Remember, we don't buy individual stocks. We hire managers. And so we rely on a lot of our manager policy selection processes to direct. If we were to have to recreate a new contract with every one of our managers, that would come at a significant cost and a significant burden. We rely on the Attorney General's office to do all of our contracting. We have a set contract with them on a budget process. We have 44 plus contracts that we have out with individual investment managers. Adding addendums or adding changes would do two things. It would increase both time and need for internal staff as well as our lawyers, as well as significantly, it would give them the opportunity, obviously, to increase costs. We're really hesitant to open the door for increasing costs on our managers. So the two pieces in regards to indexing and private equity would be my biggest concerns in regards to any legislation, and how we address that, I think, is paramount importance. And I'll give you some numbers because I think this is where it gets really scary. If VPIC is forced or feels that if we feel that the investment rate of return needs to be dropped to say 6.5%, that's a $50 million increase in the ADAC this year. By 2038, it's a $750 million increase in payments that would have to be made both through employer and employee contributions. And I think that's a significant number that needs to be vetted or looked at through a report process. And I know this bill does anticipate a report, but those costs need to be significantly vetted out before a mandate gets put in place, I'm sorry.
No, keep going.
Or I think the state would be a significant risk. I also feel if we were to have to lower, and that's just 50 basis points, if we have to lower it significantly less than that because we can't include private equity or the other asset classes that have historically been above 7%, we would, as a state, be in significant jeopardy with our pension plans, particularly the teachers. And so I voiced extreme caution. And those numbers were vetted by the actuaries. We asked them to put together some scenarios of what would happen if VPIC had to drop the rate of return.
And did you include that in your?
I do.
It is in your.
Yeah. It's on page.
Sorry, Do we already have this or?
Yeah, it's on our website.
Yeah, it's like, basically I list, it's, I don't know what page it is, but it says divesting reduces the VPIC's expected return potential. And I list a 50 basis point decrease, which would lower it to 6.5%, would require a contribution shortfall of $55 million annually and an additional $750 million through 2038. And so that's the backdrop I think that VPIC is coming from. We have three people. We index, we rely on private equity for our higher rate of return assumptions. If those are either taken away or limited from us, we will be in a significant disadvantage.
Okay, I'm gonna stop you there.
Sure.
Senator Watson.
Yeah, thank you. So I can imagine how index funds might have some percentage of fossil fuels sort of mixed in, but that's just the nature
It's
of.
probably about
indexes.
3 to 7%. There could be.
Well, and so what is your estimate around the exposure to fossil fuels in the private equity?
It's probably low. We pre-2016 had a lot more fossil fuel exposure in private equity funds. The issue is not that they have it. It's the issue they won't allow us in if we say they can't have it because they don't want to have any restrictions because they have one contract for everyone.
And is this the kind of thing that is knowable or is it sort of closed?
Well, what I did was I asked for Maine's report in regards to their divestment plan because they had a report to their legislature back in November of this past year. And they went through an exercise with a group, NEPC, which formerly was our investment consultants. And they went through the entire portfolio and they gave an estimate of what level of exposure they had both in private equity, the index funds, as well as the direct holdings. So they called them the same different asset categories. Their private equity had more, but it was because they had private equity pre-2016. And we didn't have that. So we don't have any of the pre-2016. Eric, when he talks, can really get into more detail into the private equity space because he's helped us roll that out. I imagine there is some exposure in the private debt markets. There's probably some exposure. I don't think it's more than 5%, in some of them. Some probably have none. Our real estate ones probably have none. The problem is when we go to make a contract that says you can't do this, they'll say this isn't part of our standard contract. Sorry, Vermont, you can't be a part of it. And then we have to either find one that does, that may be in a lower quartile, or not do it at all. And I think that's the dilemma we'd be in.
So you referenced that Maine has done this. You've taken a look at their policy. How do you feel about what Maine has done? Did they exclude?
Well, they haven't done anything yet.
Okay.
They're in the They have legislation.
Okay.
They have legislation that mandates it by 2026. So it's a more aggressive timeline. They went through a fiduciary plan to get a report back to the legislature to figure out how much they have. And they're in that stage right now. I don't want to speak for Maine in regards to their process. They have the same issues we have.
We'll have them in and to talk.
The cost, now, the one difference I will say with Maine, they have 9 employees and they have 18 billion in assets. With 9 employees, you can do a lot more internally. So you could create your own potential index fund. I know Eric will hate me saying that because it will increase the need for compliance or the like, but we could potentially internally do that if we had 2 to 4 more people. Maine has 9 employees. They have about 18 billion in assets.
Senator Clarkson.
Which brings up an excellent idea.
Mhm.
Have the Northeast Kingdom, I've got them on my brain. Has the Northeast thought of ever pooling resources on asset management and actually getting a bigger bang for our buck and actually, given that we're all doing retirement plans for all the exact same people, why don't we do this together? And finally save a lot more money and share all those employees.
I'm having deja vu here, only because Senator Watson will probably remember our discussions on pooling water resources here in Vermont with regional entities or pooling police, fire, and ambulance here.
Well, we've had Paco in already.
I couldn't even do it in a local area. We're still talking about it. Regionalization efforts are great ideas. They have so many hurdles in regards to fiduciary burdens as well as local entities, and that's a possibility. I think pooling of assets is a tremendous opportunity.
It sure is.
It probably won't happen in my lifetime, but because of the nature of these pools of funds, it would entail the state giving up control or access to it. It would also.
Yeah, but we have so much more time. Just think of all the money we could make.
Okay.
I don't disagree.
Let's not get too far off track here. Are there other questions for
idea.
Tom?
And the last piece I would say, and this
Yeah.
was where I really recommend you bring Katie Green in here, because she's run our ESG. Katie Green,
Oh,
she's the deputy CIO, and Eric can.
Why didn't you bring her with you?
Well, I didn't think of it until I talked to Ashlyn and she recommended it, but I really think.
oh, is Ashlyn here?
Ashlyn's here. Katie has been instrumental in formulating our proxy voting strategy as well as our engagement policy campaign. And she writes our sustainability report as well as puts together all of our carbon policy information. So she does all the vetting. My fear is if we do this, we'll lose Katie. And because Katie has really been a tremendous asset to the state of Vermont, I think she has tremendous opportunities in other states. If we're no longer doing that, if we're strictly an investment shop that buys carbon-free index funds, which I think we'd be delegated to have to do in this scenario, I think we could potentially lose some of our key employees. And then I'm not saying, I worry about that personally. Eric may not have that concern, but he can talk about it.
Senator White? No, just actively listening. Just actively listening. Senator Clarkson?
You are a great active listener. Actually, I think most of us. I would like to find out, I know you've given us all the reasons not to, so I'd always start with the reasons to do it. But we come at it, Tom, from a very different point of view. I would like to know what just to remind, because the decarbonization policy came out of some of the work that we began in 2018 on this issue. So it's one impact we've had already on this. I'd like to know the reasons to do at least the positive part of looking at the $1 billion of direct holdings you have at the moment. And what is your, just for the committee, what is your decarbonization policy at the moment, and how could we apply it to the 1 billion left that we might be able to impact if we decide to exclude index and or private equity?
Well, we apply this policy to all of our investment managers. And in fact, we got rid of one of our managers last year because of these processes. So it's already having an effect in regards to our investment management. As new managers come in,
So have you gotten rid of some of the index funds as a result?
Not the index funds, no. One of our separately managed international accounts that wasn't working, both from this issue as well as for performance issues that we felt were appropriate in our portfolio. We look at all of our policies when we're integrating this with our manager selection. And so this is a valid policy that we look at actively with any manager search or selection process, as well as our ongoing review in the year. Now you talk about what is positive of this bill.
I had to get you to respond.
Getting 100 grand would be wonderful. I don't know if I think if you're going to commit to this, it needs to be an annual commitment from the general fund. You know, the underlying pension boards have told us they don't want to spend the money from the pensioners out of this. So having a commitment from the state legislature and the general fund would be a tremendous vote of support for both us as well as for this process. What does that mean? And would I want $100,000 a year for a report? No, but I think $100,000 extra in our budget could help us bridge the gap for our employees and get more in line with our compensation underpayment. So we could then help build our internal staff to do some of these processes. If it's an annual appropriation, adding it to our budget, that would be a tremendous help to us.
So you need to build the staff capacity. Help me understand the $100,000 ask.
Well, you put the 100,000. I'd ask for more, but that's
No, but we have to be able to defend it and to talk about it intelligently. So it's meant to build staff capacity to do the work of the individual assessment of the individual stocks.
We could hire consultants every year to get you this number, but remember it changes every year based on what managers have bought, what they've sold, what we have on June 30th versus what we have on December 31st. You know, you really need someone that's either in staff, you know, monitoring this very closely. And if it's a priority of the legislature, I think it should be a priority of VPIC to have somebody on staff to do this. Managing the portfolio, and this Eric can get to this in regards to
and
what
Eric
we
has
do.
his hand up, so I'm gonna go to him pretty soon.
Let's let Eric, unless you have further questions.
No, there's just a part two to mine, which is, as you know, we have a requirement. We now have in statute and law requirement to reduce our global warming. This is one little tiny piece of how we can reduce our footprint. You know, our financial footprint is a huge piece of our investment in these companies. So I mean, this is a tiny piece of our strategy that's being done in a number of different committees. I guess I would ask, just given I guess I'd ask, when you say that VPIC has decided they don't want to go this route, because you just referred to a group, somebody deciding that they didn't want to go this way. I'm just curious, have we asked the teachers and the VSEA members about how they feel about divesting from fossil fuels directly?
Yes, I went to.
We've asked the whole membership.
I went to VSCA 2 weeks ago, presented this presentment, and it was voted 10-5 to reject S42 as written. I went to the Vermont Teachers Board last week, pension board. It was unanimously recommended to reject this bill as written. I met with the teachers as well, and they didn't vote, but they voted my support and said, come back after VPIC talks about it next week. I have a meeting with VEMRS next Tuesday to say the same thing. I have discussed with everyone in regards to this topic. They're very concerned about whether or not we will have to lower our rate of return assumption. And
So they're all more worried about the money piece.
Well, we can have them in to speak for themselves.
I don't want to speak for them. I don't want to speak for them. I have done that.
No, that's great. So that was.
So we're gonna go to Eric now.
Okay.
Thank you.
Thank you, Madam Chair.
I'll be quiet, Eric.
Can everybody hear me okay?
Yeah.
Specific to Senator Clarkson's questions, I'd like to talk about some of the positive things we have explicitly done to address global warming and to reduce the carbon impact of our portfolio. Empirical studies have continued to show that divesting of these companies simply does not work. It does not change their behavior. It does not improve their behavior. It does not reduce carbon emissions. It does not improve investment performance. Instead, study after study continues to show that engaging with these companies through proxy votes can and does incentivize them to be better citizens. Tom mentioned some of the work that Deputy CIO Katie Green has done in this space. There's one very large energy company who was flaring a lot of excess methane in the Bakken region. If you know anything about methane, the concentration of CO2 is more than 50 times higher than that of gasoline or oil. So reducing flaring, big economic win. The question is, could we get the company to agree to do it? We could have sold the shares and walked away from that company. Instead, we kept those shares and sponsored a proxy initiative with them to get them to commit to reducing flaring in the Bakken. Working with the company's management team and the board of directors, we were able to incentivize that company to get, they committed to actually, number one, targeting reductions of flaring in the Bakken. Number two, measuring those emissions in the Bakken. Number three, setting specific goals for their management team to reduce that flaring. And finally, and most importantly, incorporating those metrics into their company's management compensation plan. So their incentive comp now is tied to reducing flaring in the Bakken. There are countless examples that we talk about in our sustainability report that you can see on our website at vpic.vermont.gov. And these examples go far beyond just environmental issues. There are equality issues, DEI issues. There's a very prominent bank who, thanks to our efforts in engaging with them, agreed to consider a diverse slate of candidates for every director search. This was a room full of old rich white guys that did not want to have a discussion with us, but because we had a proxy vote, because we had these votes, we had a voice in the boardroom, they were willing to work with us to actually amend their corporate bylaws to commit to, when they're doing searches for new directors now, to absolutely commit to considering diverse slates of candidates. We're working with the company now to better disclose how what they're paying for lobbying expenses and what they're lobbying on. These things tend to be buried in financial statements as just expenses, but we want them to better disclose what types of things they're paying using our money to finance and what types of things they're lobbying on. So there are countless examples of where we've been able to use our proxy votes to improve corporate behavior, to improve results, to actually address specifically head-on not only financial risks, but also risks tied to any of these environmental, social, or governance factors. In our view, these factors are every bit as important as the financial metrics that you hear about so often on Wall Street. To the extent that companies are not adequately taking into account future carbon taxes, future stranded assets, future governance issues, future discrimination issues, those things have can and do have significant impacts on companies' current and future profitability, cash flows, valuations, things that go directly to the bottom of the bottom line of VPIC. So these are very important issues. Our concern is that simply selling these companies to a less responsible shareholder lets them off the hook to a shareholder that's not going to hold them accountable. We do retain as a last resort the ability to divest of a company where we feel they're not making progress on these issues or where their management of these risks presents undue levels of risk to VPIC and the portfolio. But as Tom mentioned, as nationwide, we're seeing a downward trend in pension fund discount rates. We've seen it in Vermont. Not too many years ago, we were north of 8%. A few years ago, we lowered it to 7.5%. A few years after that, we lowered it to 7%. The industry is increasingly headed down into the 6s. We're doing everything we can to keep the discount rates as high as we can, because every 50 basis point reduction in that pension fund discount rate brings with it an annual increase of pension funding expense over $50 million to the state just for the teachers and the employees' plan. So this is real money. And to the extent we get shut out of things like illiquid assets, including private equity, private infrastructure, and private credit, you're really taking those asset classes away from us that are giving us the ability to keep those returns at a high and compelling level. These defined benefit plans nationwide are great vehicles, but they're only great if they're sustainable from a taxpayer funding standpoint. This isn't just about more benefits, more benefits, more benefits. This needs to be about having the right level of pension benefits in place to attract and retain a qualified workforce, but at a level of cost that's reasonable and sustainable to the taxpayers. We're doing everything we can on the investment program to make that affordable, to make it economically viable. The tools that Tom mentioned, index funds and these low fee products that we're using, private equity, private infrastructure, private credit, these things all combine to help us maximize returns of the fund with imprudent levels of risk and liquidity. So we're trying to optimize not just returns, but having enough cash on hand to pay benefits. That mandates that we hold assets in different asset classes, public stocks, private real estate, things like that. To the extent we own these assets, we have a voice in how they're managed. Again, just selling these assets to a less responsible shareholder abdicates that role, gives that vote to a less responsible shareholder that, in our view, probably isn't going to go head to head with the board of directors of an energy company and not back off until they show us clear metrics and clear plans for reducing their emissions.
So
we take it it's a very serious responsibility. We share your views on decarbonization and the importance of it. We share your concerns about climate change. I think the last point I will make is that the view, it used to be the view that, well, these energy companies, these are just bad investments. They've got a bunch of fossil fuels in the ground and they're going to be dead assets at some point. Unfortunately, that just hasn't panned out. The reality is we need these transition fuels to get us to a low carbon economy. Fuels like natural gas that are less carbon intensive than oil and coal. The other piece of this that we think is important is that the energy companies are the companies that have the scale and the research dollars to lead us to a low carbon transition. They're probably not going to do it as quickly as we want them to do unless we're asking them through our proxy votes to do so.
So the fund managers, you both mentioned, or especially you, Tom, were mentioning fund managers that were refusing to sort of participate in managing the index funds from a low carbon perspective. And when you apply the whole concept that Eric was just talking about engagement through proxy voting, it doesn't sound like engagement through proxy voting is working in that instance.
Well, the indexes are we're talking about the direct holdings. We have proxy votes on our direct holdings.
Yeah, no, I understand when you have proxy, but I'm talking about engagement, the engagement versus divestment. So that's what I hear you arguing for, is that the path that you believe works better is engagement.
This is equally,
excuse me, Eric, I'm asking Tom. Thank you.
Okay.
So that's what I've heard you argue, engagement versus divestment, but it only works on some kinds of your funds. And it feels like it sounds like you've hit sort of a wall on your engagement in the large part of your portfolio.
Well, I disagree with that analysis. I think we use we have the S&P 500 equal weight, which I believe we have as a separately managed account, which gives us positions, little positions in every single one of those companies. So we have positions in a lot of these companies that we may have additional positions of the same stock in an index. It's just at different levels. We index to get the diversified level of a global portfolio. To lower our volatility and to lower our risk level. We're not indexing per se to own the stocks or to be able to use those as proxy votes. We own our separately managed accounts for that basis. Now, it happens to be about $1 billion. We could scale that up or down. What we haven't done that internally because we don't have the staff to do so. We also, as part of our policy, have specifically moved some of our index assets to that low carbon index fund that BlackRock put together for us, with the idea that other states in the region could join that as a compact. And that was the whole goal of the 2018 divestment review, to come up with an index strategy. So I wouldn't say we're failing in that. We are approaching that from a different angle. We're using our low carbon index investment that has about 250 million in it, with the idea that we could potentially put a lot more. The problem is one of our other index funds is more global, and global is there's less indexes available. And so at this point, we're using a broad global index. As they come to the forefront, we will definitely look at them and review them in light of potential changes. That's an ongoing process. So I don't want to say we're not using those. It's just we use them differently.
Okay, Eric, did you have something to add?
I did, thank you. I'm sorry for interrupting. So this is actually a very important initiative for our index fund managers, the commingled funds. BlackRock specifically, one of the reasons we hired them was we agreed philosophically with their corporate proxy voting policies. We agreed philosophically with their CEO's views and his efforts to engage with companies on our behalf. We're actually working with them now to begin to leverage a new technology that would allow us to apply our proxy voting guidelines to those assets, even though they're part of a commingled fund. So I would say more to come there, but we're optimistic that we can have an increasing say of how those proxies are voted, even within the commingled funds.
Okay, great, thank you. Are there other questions at this point? And you mentioned first of all, we'll have Katie in. And you mentioned a site on a page on your website that.
Oh, yeah.
Where
vpic.vermont.gov. We have our sustainability report on there.
the sustainability report.
Yeah.
Okay.
And that's what Katie does, right?
Yeah. Katie's been instrumental.
We have Katie and she could maybe take us through that report.
And she's also part of, I believe she's part of the HarborVest ESG committee. There's some committees that we've been offered through some of our managers where they invite our staff to be a part of it. It's more of it's an internal sort of policy review, and these are definitely the issues that will come to that. So you can affect change at some of the larger financial institutions, whether it's with BlackRock or whether it's with HarborVest or some of our investment managers.
Okay. All right, yeah, I see the lovely website. We'll have her in to talk to us about that. And Senator Clarkson, you want?
No, I just, my brain was somewhere else, but how is the low carbon index that was put together by BlackRock doing? I know you only put a small amount of money in it, but how's it doing?
It's actually lagging the traditional cap-weighted benchmark index because the energy companies have been outperforming.
Yeah, no, I know they have.
Well, that's a one-year event, so we're leaving it as long-term, and we anticipate that that's going to become a larger.
Well, we'll hope that changes.
Okay. Well, thank you. This is a good introduction for us.
Thank you for having us.
Yeah, no, well, I'm sure we'll have you back. But hopefully next time there's not some kind of building event. And that we can have you in without interruption.
I view us as partners.
Go ahead.
I view us as partners in this process. And I think legislation to me becomes it's harder to change. And financial markets are rapidly changing. And so we want the ability of BPIC to be able to rapidly change as this economy transitions. And so we respectfully don't agree with you on divestment, but we think that we can be partners in this effort because we share your concern. We do believe it's a
You've
critical.
responded to our concerns. The legislature's had these concerns for the last 10 years.
Yeah.
So Beth fought hard. Beth has always fought on engage. We can change, even though we're pretty tiny.
Yeah.
So I've always loved her optimism on that. And so we appreciate your coming inch by inch towards this value. And we appreciate that. I am sorry that the membership is generally more supportive of, I mean, I can understand their retirement is dependent on this. I get that.
Well, it also
but-
seems that engagement is fairly limited when
Yeah.
you're seeing that the fossil fuel investments are still dominating.
Yeah,
And
and doing very well.
that just is really concerning to me. So there's clearly limits on engagement.
Yes.
And so it would be great for you to think about how can engagement be more successful and what could we be doing better in that area? And what can we, if you want to partner with us, what can we
Right.
help, what can we ask you to do to help you do that? Because we're working, two of our members are working their butts off down the hall to try to pass really important legislation to lower our carbon emissions in the state. And it's just a bad look for us to be investing in companies that are then creating carbon emissions elsewhere or creating environmental detriment.
I think the industry is becoming much better at measuring and holding companies accountable for a net zero future. And I think the UN protocols that Katie is working with, I think is emphasizing that. So I think what you're going to see is less talk about divestment and more talk about net zero and how do you implement a net zero approach in a portfolio, and that's evolving. But I think staying by those principles, whether it's the UN protocol or whatever, we've listed a bunch of those. I think that's where investment will come about and will affect change realistically. We can lead in that effort. If we just pull away from the table, we won't, and we'll end up having no voice. And I think at least with us, we can have a voice. Maybe we're little, but we can help garner support of larger pension funds. Our pension advisor out of Portland has $1 trillion so in assets. So if we get on some process or program, we do have the right individuals that we're working with. We're working with BlackRock in seeding this fund. It hasn't taken off because of the market, because energy stocks were so good last year. It may come around, and suddenly that fund that BlackRock created for us could become $1 billion fund, could become a $2 billion fund, and then we'll have real power because we will have started it. It's just
Right.
us now, but.
Well, we'll have you back to talk about it, and we'll have Katie in the meantime. But thank you very much for your time today, Tom, and
Sure.
you too, Eric. I hope you
Thank
feel
you.
better soon. Thanks for joining us remotely.
Thank
And
you.
I'm sorry we have to move because we have other witnesses waiting.
Thank you, I appreciate it.
Thanks, Eric, for your.
So Gavin, do you mind coming up? Thank you for your patience. We're way behind here, I see. If you want- Okay. Gavin, what's your timeline? Are you,
I have plenty of time.
okay,
Hopefully. I think I have until about 4:30.
we have two remote witnesses,
Okay.
so we're trying to figure out if we
One-
should
They haven't expressed that they're.
I would,
have an express concern yet. Okay, all right, we're gonna go with it. They haven't told us
Okay.
if they have to leave, so
right.
if you wanna just introduce yourself and, wait, you haven't been in here yet, so we'll do a quick introduction.
You were here with Michael. weren't you?
I did come in for just a brief introduction.
Then you should just go ahead, you know who we
Okay,
are.
well, thank you. For the record, Gavin Boyles, the Deputy Treasurer. Good to be here, and I extend apologies from Treasurer Pichak, who couldn't make it today, but he sends his regards. So I wanted to begin by just saying, the Treasurer's Office, also in agreement with the goals, much work before my time, obviously. I've only been in the office a month, but on these issues. And I won't belabor the points that Tom made about, the difficulty of balancing the fiduciary obligation to our retired teachers, municipal employees, and state employees with the importance of this issue, which is paramount, obviously. So, I think Tom highlighted some of the past reports on these issues. The Treasurer's Office itself has done a few reports in 2015 and 2019.
Yeah.
Those are on our website. You know, the policies that he mentioned, I'll also echo, you know, I think it's great that you're gonna have Katie Green in here. She's really just a gem and extremely knowledgeable and really a national leader on this. I wanted to provide a little bit of,
Sorry, Paige.
a little bit of additional background, you know, just trying to understand, you know, the goals of this legislation, which I understand to be, you know, to kind of apply this thinking, whatever is landed on substantively as far as what happened, but to apply that to the funds that the state holds. So I wanted to highlight just a couple.
Putting our money where our mouth is.
Yeah, I just wanted to highlight, exactly. Just wanted to highlight a couple of other funds that are not the pension funds that are named in the bill right now. So I leave it to you whether to include those, but the Treasurer's Office does, you know, in addition to the funds that are named in the bill, we hold what's called the trust investment account, which is, these are all quite small compared to the pensions. The trust investment account in particular is quite small, but it is.
Tell us what it is.
Yeah, let me turn to Ashlyn for what's actually in it. It's about $45 million and.
Yeah, so for the record, Ashlyn Doyon in the Treasurer's Office, there are a number of things. It used to be your tobacco trust funds were in there, except that's very small now. The Higher Education Trust Fund and other special funds like Fish and Wildlife has a bunch of small.
Right, all these the
Yeah,
special ones.
Yeah.
And
so-
opioids in there too.
It's coming.
I'm not sure, maybe.
It's coming.
About 3 million is in there, so I
Okay.
think.
Yeah, Yeah.
Or that actually is held by a separate fund manager, so forget it's not.
Okay.
And someday there may be a fossil fuel fund coming in because all these companies are gonna have the liability of the fossil fuel companies.
All right, Senator.
So I mentioned that, the other funds in this category are the OPEB accounts, which is the other post-employment benefits accounts, which, as you all probably know, we, you know, used to just pay as we go, and now we're working on pre-funding those to reduce the unfunded liability. So those funds are growing. Those are about 200 million right now. And the TIA and OPEB funds currently are all essentially invested, you know, sort of somewhat similarly to the pension, but a little heavier on the index fund side. They're just smaller. We manage them directly in the Treasurer's Office.
So those aren't direct.
So there are those. The other big bucket is sort of short-term cash, which I think doesn't really enter into this this discussion because none of it is invested in the traditional sense. It's in very short-term vehicles, treasurers and things. So I just wanted to mention that just by way of sort of, you know, full disclosure of all the sort of potential investments that could be affected by this. The other,
Just 1 second, Senator Watson.
If they are directly managed, do you have a sense of the exposure that those have to fossil fuels?
yeah, sorry, and I was a little imprecise with my language. I say directly managed by the Treasurer's Office, meaning only that we decide what indexes they're invested in, not VPIC.
Okay, is it only indexes?
Almost exclusively index funds. There's a little bit of maybe 10% of them in sort of some private investments in real estate and things. But I think it's probably safe to say that there's index fund only exposure
Right, and
to
no
fossil fuels. Certainly no direct.
holding.
No.
Thank you.
One other thing I wanted to kind of jump off from Tom's testimony, he mentioned that, you know, the industry is moving in this direction, and, you know, meaning the investment industry and the fund management industry. And I wanted to highlight another respect in which that's true, which is that the SEC, and I just was down in DC with Treasurer Pichak actually yesterday, speaking with someone about this. The SEC is introducing a rule in a month or a month and a half that will require much more robust climate disclosures from all publicly traded companies. And so, you know, you should certainly hear from others about this, but I think it's reasonable to think that the availability of low-cost indexing vehicles, like low-cost indexing vehicles with a low carbon lens on them, will increase over time.
No.
You know, because as this information, and the SEC rule calls for what I'll say is sort of meaningful empirical information about both, I always forget, they call them stage 1 and stage 2 emissions, I believe, which is sort of direct and indirect emissions. So a company like Amazon can't just say, well, we're not a fossil fuel company. They have to disclose the emissions from their trucks, for example. So I think that's, that's a respect in which the industry is moving this way. I think under our existing policies, it's pretty clear to me that as it moves that way, that's something that BPIC is going to be looking at very closely. It's certainly something that Treasurer's Office will look at very closely. And having said that, it's moving. It's a slow movement, and I understand that's not always the speed at which everyone wants to move, but it is, I think, predictable and reasonable to anticipate.
Sarah Clarkson.
Do you have a notion of when that rule will be actually activated? It's introduced, but do you know when it'll be? Because they all have to abide by it and your index funds will have to, who will respond to that rule? Will it be levied at fund managers or will it be levied at index fund? Who's it?
Well, it's actually, so the rule is directed at publicly traded companies, right? So the company
So
itself.
it'll be directly to the direct companies themselves.
Yes. But then it gives fund managers and indexers, just a much more empirical way to say, okay, we're only going to invest in companies that, whose tier 1 and 2 emissions are below X. So I think, and I think one thing I will say that's been clear to me just in the, 5 or 6 weeks I've been in office and working with BPIC is that they are vigilant about opportunities like this. I do.
So do you think that rule would give more opportunity for direct engagement on index funds? Because that's what seems to be, right now, if you don't have a proxy vote on an index fund, how do you engage with them? And so if this is a way to provide an avenue for engagement, perhaps.
Yeah, and I think, and I would defer to Tom and Eric on this and Katie, but I think the way you engage with an index fund typically is by either buying it or not buying it.
Yeah. It
So
seems like a lame level of engagement. So
well, no, fair. And the point I was just trying to make is that I think there will be more choices.
Yeah.
And
Okay.
the choices will be better and more meaningful. I mean, I think there's, and again, I don't want to speak for Tom, but there has been a documented problem in the index fund space of funds saying they're green and they're not.
Right.
And so
Yes.
that's something we want to avoid as well. So I do think the SEC rule is a substantial step in the right direction on that front. So, I want to highlight that. I think, I would echo, and we as an office would echo much of what Tom and Eric said, which is, they have done a lot of work in this. I do think the engagement is important. It is a small amount. The flip side of that, of course, is, if we were to swiftly divest, it's also a small amount. So, that's no great insight there. And the other thing I just wanted to say is, I do think there are some models that are, that are perhaps a little more flexible and have a little bit of a longer on-ramp. I think Middlebury College is one, and I was glad to see that I think David Provo is coming in to talk to folks. They have a plan to move in this direction. I think it has a slightly longer timeline than this bill, which I think would be helpful.
Most of the large universities do now.
Yeah.
Yeah.
And so I certainly think it's good that you're hearing from them. I do think the Middlebury policy and many of those other policies, and I can't say I've looked at all of them by any means, but many of them do exclude index funds and private holdings, the sort of private equity. And I think, they've all presumably had conversations like this one to get to that point.
But not in public on YouTube, so.
Couldn't say.
Yeah, I know for sure.
Yeah.
So, our transparency is a little more. Anyway, what else, do you have other things at this point that you want us to, or feedback besides?
No, I think that's it. I think, I think just really happy to be a partner on this. And if folks have questions, always happy to engage and talk more.
Great. Senator Clarkson.
Last question for you, yeah. The unclaimed properties money. At a certain
Yes.
point, no, at a certain point, we assume it into the state budget. Or into, so it's something we could look at a certain point, whatever that is. We could directly invest these into companies that were responsibly reduced their carbon footprint. I mean, could we, Ashland has an answer.
Well, I'll respond quickly and then happily
Yeah.
let Ashton speak as well. I think right now, obviously that would take a statutory change. I think right now what happens is that I think 55% of what is not returned to folks every year comes into the general fund to be allocated as you all see fit. So, that would be a statutory change. One aspect of that, I mean, obviously it's just a statistical sort of estimation of how much can we safely use for other purposes while still making sure that we can return the property of anyone who asks for it.
Mhm.
Because nobody ever loses the right to get their property back.
Oh, I understand.
So, yeah.
But a lot of those people are dead already. I mean, a lot of the people who could have claimed it are gone.
And their heirs can claim.
Up to a certain
Essentially.
point. You don't go forever.
We do by statute go forever. I mean,
No.
technically, right?
Heirs don't
Understood,
go.
yes.
Oh, they might.
Okay, this is getting a little off track here, and it's really not that much money, so,
No.
what, quickly?
Sure. I just want to be clear that the unclaimed property fund is not like a fund of money that's sitting there. The unclaimed property fund operates as like a liability on state's cash. So when Gavin mentioned that our cash is invested in short-term vehicles like treasuries and CDs, it's there. And then some specific types of unclaimed property are stocks. But those are that person's stocks that they invested in at that time that then got lost. And so I definitely appreciate the idea, but it's not, but conceptually, it's just, I don't.
It's complicated.
Yeah. Hopefully that comes.
Okay, well, Gavin, thank you so much, and thank you for your patience too, as we had a messed up schedule today, so.
Appreciate it. You're gonna be at BAA for an hour.
Yeah, I didn't think it was gonna happen. Anna, are you there?
I'm here. Can you hear me okay?
We can. Are you able to show us? Yeah, video, yay.
Okay.
Thank you so much for joining us today and for your patience. Apologies. We had a much longer floor session than anticipated, so we're behind schedule. But if you're still able to join us, we're really happy to have you, and hopefully you can give us sort of more national perspective of what's going on with divestment around the country with state pension funds and other state funds.
Absolutely. Thank you so much. Bear with me just a second as I try to figure out how to share my screen so I can walk you through my slides.
No, she should be able to.
You just got the ability to share screen, hopefully. And while you're doing that, we'll just, so you can hear in the background, introduce ourselves. I'm Senator Ruth Hardy. I'm the chair of the GovOps Committee in Vermont.
Olivia Parker, committee assistant.
Senator Tanya Biehovsky, Vice Chair.
Rebecca White, Windsor County District.
Bob Norris, Franklin County.
Senator Ann Watson, Washington District.
Allison Clarkson, Windsor County District.
Well, it's so nice to see you all. Thank you so much, Senator Hardy, members of the committee, others for inviting NCSL to share some perspective on recent state legislative developments around pension fund divestment and fossil fuels. As you know, my name is Anna Petrini. I am a project manager in NCSL's Employment, Labor, and Retirement Program. Most of my work focuses on pension and retirement topics, and more recently, issues around disability employment. For those who are not familiar with NCSL, the National Conference of State Legislatures is the country's most trusted bipartisan organization. We have been serving legislators and legislative staff for 40 years. We promote policy innovation, create opportunities for lawmakers to share knowledge, and we try to ensure that state legislatures have a strong, cohesive voice in the federal system. So, quick outline of my remarks today. I think state activity to divest pension assets according to a range of often very politically charged policy aims are constantly sparking new debates and reviving old ones. Among them, what is the proper role of states in international affairs, and how can pensions square their fiduciary obligations to retirees with calls for socially and environmentally responsible investment? Today, I was hoping to touch on some of the history and recent trends in this area and delve into the state legislative landscape with a special focus on climate risk policy, and then give a very brief overview of some legal and public policy considerations that I gather have been discussed by other folks before you today. Typically, I would start with some definitions and level setting. There's a whole constellation of terms in this area, but I think other presenters have probably covered this amply. I will offer a little historical context and then move on to talk about where institutional investors are integrating ESG factors into their decision-making and where they're not. And then hopefully we can touch a bit on the sort of why piece of this equation is shaping social and environmental change. What's driving these policies, or is it boosting investment returns? Is it both? If so, which one predominates? So I think it's safe to say that globally, the integration of ESG factors into investment decision-making has accelerated in recent years. I think ESG investing has been common in Europe and Canada, and there are definitely prominent US pension funds, including CalPERS and CalSTRS, two of the nation's largest, that incorporate ESG principles into their investment processes. I know the Center for Retirement Research at Boston College issued a report about, I think 2 years ago now, that found that public pensions apply ESG criteria to about $3 trillion in assets in the US. Climate risks may be especially relevant for institutional investors like pension funds that need to sustain growth over long time horizons. But there is a growing divide in the ESG regulatory landscape that has emerged and deepened as dozens of states introduce new initiatives in recent years that are seeking either to divest state pension funds from oil and gas or coal companies, or conversely, to require state pension fund divestment from entities that boycott fossil fuel companies. At least one state, Indiana, has considered measures both to divest from fossil fuel companies and to divest from fossil fuel boycotters. So layered on top of state legislation on divestment and state contracts, there are also a host of state task forces and investigations and committees that are reporting on encouraging or discouraging ESG investing. And then layered on top of that, you have state attorneys general and treasurers and other officials who are weighing in. And then finally, some pension funds have adopted their own ESG investment and proxy voting policies, in some cases, despite other state mandates. So,
Or energy sector.
No, it's environmental social governance.
Oh, because you don't ever explain what ESG is. So thank you. I thought it was energy sector, but it's environmental.
Social governance.
Okay, it's not said.
What is ESG, just so we're all clear on it?
yes, thank you for the clarification. So it's integration of environmental, social, and governance factors into decision making. Most of what I'm talking about today is the environmental piece of that, but there is a great deal of legislation that's focused specifically on social goals and to some extent on the governance of companies as well.
Great, thank you, thank you.
So 2019 was an important year because California adopted a thermal coal divestiture bill. And I think since then, the idea of fossil fuel divestment has continued to gain traction among states, cities, universities, other types of institutional investors at home and abroad. I think if we're looking at a few sort of broad policy issues in play, proponents suggest that energy companies may actually pose a long-term risk to fund portfolios because they hold stranded assets, right? So fossil fuels that can't be consumed without triggering the worst effects of climate change. There is also regulatory risk. Here, climate change risk could also lead governments to regulate oil and coal companies so extensively that their stocks eventually take a hit. But simply identifying companies as targets for divestment can be a tricky proposition, especially as oil and gas companies begin to shift toward producing other forms of energy. Very often, you'll find legislation in this area that calls on retirement plans to constructively engage with companies before pulling out in order to assess the degree to which they're transitioning to clean energy generation. As you are likely aware, in 2021, Maine became the first state to enact a law requiring its $17 billion public employee pension fund to divest of any fossil fuel holdings by 2026. Like your legislation in Vermont, it requires divestment of existing holdings and then prohibits certain investments moving forward. MainePER's executive director, when that was enacted, said that fossil fuel investments in that state represented $1.34 billion or 7.6% of the total pension fund assets. And like your bill, it focuses on the 200 publicly traded companies with the largest fossil fuel reserves in the world. It also targets fossil fuel infrastructure companies. If we look nationally at state legislative activity, let's see. In 2021, I tracked legislative proposals that would direct public pensions to study or abandon certain types of fossil fuel investments in a handful of states. I think Colorado, Hawaii, Massachusetts, New Jersey, New York, and then of course, Maine, as I mentioned. This year, I'm aware of bills that have been introduced in California, Connecticut, Hawaii, New York, and Vermont. Beyond bills that are specifically addressed to fossil fuel divestment, there's a fair amount of legislative activity that aims to impose a broader affirmative obligation to evaluate investments in light of ESG considerations. So a couple of examples here. 2019 saw legislation enacted in Illinois, and it provides that all state and local government entities that hold and manage public funds need to integrate what it calls material sustainability factors. And if you look at how that's defined, it's essentially ESG into their decision making. 2022, Maryland did something notable. They enacted legislation to address climate risk in their state retirement and pension system. It's a different approach than other divestment legislation. The concept was not to limit the system by only directing divestment, but to sort of provide a larger toolbox. So the bill offers divestment as an option, but it also directs the system to engage with companies on climate issues and to seek out investment opportunity in the renewable energy economy. Significantly, I think the Maryland law codifies as a fiduciary duty the consideration of climate risk in its investment operations. And then there are a whole host of sort of non-legislative initiatives. I mentioned often pension funds themselves are formulating and implementing policies along these lines. I could go into some detail here, but I think in the interest of time, I will move along. I had wanted to highlight just one bill that's being taken up in California right now to provide a little bit of contrast to your activity in Vermont. So this legislation in California is similar to a bill that was introduced in 2022 and didn't pass. It's aimed at CalPERS and CalSTRS, and like many other bills, it would prohibit investment in the 200 largest publicly traded fossil fuel companies. It has an interesting provision about the timeline. So it has sort of a 7-year off-ramp that it lays out for divestment, but it temporarily suspends this liquidation activity in the event of an act of God or a war or an other type of unforeseeable event that would materially impact normal market mechanisms for pricing assets. So that's a mouthful, but I think you kind of get the idea that it has this exception to the timeline built in. There is language about consistency with fiduciary responsibilities. There's a hold harmless clause for board members, investment managers, and research funds who are involved in executing. And then there's language around study or reporting requirements. There is a lot of sort of context that we could elaborate in California. I don't want to go into too much detail here, but there was a 2019 executive order that established a state climate investment framework. CalPERS and CalSTRS have committed to reach a goal of net zero investments sometime in the next 27 years. So I think every state is different. California has a lot of sort of different layers in its framework around the legislation that's being considered now, but I just wanted to submit that.
How does that legislation deal with index funds, which is what we were talking about beforehand?
And private equity.
That's a fine question. I don't have it in front of me and I don't want to misspeak, but if it's okay, I will absolutely look at it once we're offline and send you some language that I'm able to pull out there and maybe a little bit of context as well. Is that okay?
Okay. Yeah, that's great. This is just a barrier that we were just discussing with, the limitations of being able to divest from index funds and private equity funds.
Sure thing.
Thank you.
Of course. One other area that I think is worth mentioning is in sort of stark contrast to everything I've been discussing. Governors, treasurers, legislators, and other officials are taking a strikingly different tack in a large swath of the country. So I pulled this information from a resource that is put together by the law firm Ropes and Gray. It is a very comprehensive resource and I think is worth consulting if you're trying to get a picture of what's going on nationally. But this isn't sort of NCSL generated research on state legislation. So I just want to give credit where it's due and also refer you to this as a resource as well. But in these states, so originally sort of the charge was led here by energy producing states like Texas and North Dakota and Oklahoma and Alaska. That were mulling over laws or policies limiting transactions with companies that have called for divestment from the fossil fuel industry. I'll pull out Texas here as an important example. I mentioned 2021 was kind of a watershed in Maine. Texas was doing something starkly different at the same time. Texas has one of the largest public funds in the country, and its legislation prohibits Texas pensions from investing in companies that boycott fossil fuels or have other restrictions on the oil and gas industry. And so there is, I think, a lot of conversation about boycotting activities and financial institutions and the limits of the state's ability to do business with those financial institutions in light of their investment commitments. And then there are another set of states, North Dakota is among them. North Dakota enacted legislation in 2021 that is, these states are looking at investment decisions and their ability to inflict economic harm through the integration of ESG factors. So I know this is very far afield from what you all are contemplating in Vermont, but I think definitely worth having a sense of what's happening in a large swath of the country, and maybe thinking through considerations like the effect on asset managers who operate across states with very different policies in place.
Yeah, that is a really good point and depressing from our perspective.
I do not want to dwell on federal legislative activity and regulatory activity. It's kind of outside my comfort zone a bit, but I think it's worth mentioning here just because there is this sort of Department of Labor whiplash phenomenon depending on the administration. So I think under the previous administration, the Department of Labor had issued a regulation that signaled a high degree of skepticism about ESG investment practices. And the Biden administration has reversed course, and in November, the Department of Labor announced a final rule that allows plan fiduciaries to consider climate change and other environmental, social, and governance factors when they select retirement investments. Big caveat here. So public pensions are not covered by ERISA and are therefore not directly affected by all this back and forth at the Department of Labor. However, state policymakers and retirement system leadership are certainly paying attention to this, in part because the regulations and commentary could inform analysis on potential fiduciary breaches under state law at some point. So there's also federal legislation that's been introduced. I am not going to go into that. I think your other panelists have talked at great length about sort of policy considerations. And so I'm not going to go too much into the sort of if you don't buy it, someone else will types of arguments, although I think those hold a lot of currency for many people who are thinking through these issues. And same with the questions around like the effect on targeted companies and whether those are limited and what happens if opportunities for shareholder activism disappear. But I think questions about how investing that is informed by ESG factors affects returns are really salient. I will refer you all to some research by the Center for Retirement Research at Boston College on state investment directives and plans ESG policies. They looked at these over time and I think determined that there were reductions in annual returns of 70 to 90 basis points, in part because fees in ESG funds can be higher. Screening is resource intensive. And I think there was a study done on CalPERS when they divested tobacco stocks. I think a 2018 report found that they may have missed out on $3.6 billion in investment gains. But if you look at other types of divestment initiatives, those have worked in its favor. Those have been much more advantageous. So I think there's a lot of interesting research out there sort of trying to quantify all of this. I'll end by saying that the passage of divestment bills, no matter what the issue, right, whether they're targeted at Russia or fossil fuels, seems to create strong incentives for the development of yet more divestment bills. So we're sort of considering, where this might lead in the future in terms of other types of policy prescriptions. And I think with that, I will thank you all for your time. And if you have questions, I'm delighted to try to answer them now. Also happy to follow up offline.
Great, thank you so much, Anna. One thing I'll ask, and somebody else, one of you mentioned that report from Boston College. Is it Boston College or Boston University?
Ropes and Gray, I thought.
For the Center for Investment Research. Could you send us that report?
Yep.
That would be great.
Was that the Ropes and Gray report?
That's different, and I'm happy to send that as well.
I'm glad to see that NCSL is partnering with the most expensive law firm in Boston to do a report.
I don't think it was their report. It's not their report. Anyway, well, Anna, thank you so much for your time today. We are gonna move to our next witness since we're so behind. But this has been really helpful to get a national landscape and slightly depressing too.
Yeah, that was super depressing.
But thank you. And we'll be in touch if we need more information from you.
Sounds good. Thank you so much.
Take care.
Bye-bye.
Yellow and orange map was really
Okay.
ready to slit your wrists. It's like, really. Unbelievable.
It's protectionist. That's where the fossil fuels come.
Oh, look, that must be Middlebury.
That is Middlebury.
Hi, David.
Good
Thank you
afternoon.
so much for your patience today. We spent a little bit more time on the Senate floor than we had anticipated, so we're a little behind. But we've already had some good testimony, and we're gonna just quickly introduce ourselves so you know who you're talking to, and then just turn it over to you to give us a brief overview of Middlebury's divestment strategy, the process you've used, and where you're at with it, and what you think we should know in relation to possible state pension investment. And it's, as I said to you, and when I emailed you, you don't need to take a position on the bill. We're just looking for information from you as to how Middlebury has done what it's done.
Great, no problem.
So, as you know, I'm Senator Ruth Hardy, and I represent the Addison District, including Middlebury College.
Olivia Parker, Committee Assistant. Senator Tanya Bielowski, Chittenden Central.
And Rebecca White, Windsor County District. And Watson, Washington District.
Allison Clarkson, Windsor County District. And it's interesting to see how global warming has already hit Middlebury big time. Their trees are already leafing out,
Yeah,
and it's February 16th.
It's the Banana Republic down there.
Absolutely.
All right, thanks, David. Go ahead.
Okay, great. So thank you. So I've been at Middlebury 6 years. When I arrived in 2017, the college had just achieved its goal of carbon neutrality. That was primarily focused on energy usage and sources of our energy. The college was able to achieve that through primarily through credits from protecting forever the breadloaf forests. So President Patton arrived in 2015. She said, what's beyond carbon neutrality? And there was an effort to develop Energy 2028, which was a comprehensive plan to achieve a number of goals. One of them to be considered at the time was divestment. The history of this at Middlebury is long. Student activists, faculty have been asking the college's board to divest of its fossil fuel holdings and its investment in its endowment now for probably 20 years. Middlebury, of course, was the first undergraduate college to have an environmental studies program, and that dates back to the 60s. So you can say that it's kind of in Middlebury's DNA. So if anyone was going to tackle this, President Patton wanted to see if Middlebury College could. Other colleges and universities had, but it had been a slow go. So I had a group of students who worked closely with me who were student activists. They wanted to march on Old Chapel, and we got them to come to the table and work with us. And ultimately, they ended up presenting to our Board of Trustees around making a generational argument around divestment. And they did a very good job, as bright college students do, making the argument that our own mission statement says we exist to actually educate students to deal with one of the world's most challenging problems as a liberal arts college. And they made the case when they finally did present to the board in consideration of Energy 2028 in 2018, making that argument of a generational issue that our generation is handing them a big problem. And why wouldn't we work with them to help address it? So an important aspect of our divestment plan was that it was in a comprehensive plan that also is holding us accountable to reduce our usage of fossil fuels by usage of energy by 25%, and to find renewable energy sources locally for all our thermal and electric needs to run the campus. And we're well on our way with that. with a biomethane plant in Salisbury, and we're adding a 5 megawatt solar project. So then that brought us to the divestment. At the time in 2018, about 5.7% of our just over $1 billion endowment was invested in fossil fuel companies. The majority of that was in private equity investments with what we refer to as long tails, meaning they were committed dollars for 5, 10, 15 years. So we went through an educational process with the students to explain to them how our endowment works. Our endowment is managed by an outsourced CIO. It's called OCIO, and that is Investor, and they're out of Charlottesville, Virginia. When they invest in private equity funds, they take $1 million from Middlebury and $1 million from 13 other clients and pool those funds and invest them with a money manager. So back in 2013, when the board took steps to invest more in sustainable energy solutions, they did not feel we had a path forward to divest in 2013 because of the complexities of unwinding from the pooled investments. So what changed in 2018? Investor had made a significant investment into being able to allow clients to opt out of their portion of any pooled funds, which gave us that flexibility. So in 2018, when we passed Energy 2028, we created a path forward to divest of our fossil fuel holdings over time. So the first step we did is, because we now had the ability to opt out, any new money was prevented from going into fossil fuel companies. And we defined it similar to how your wording in your proposed bill is. It wasn't around the 200 dirtiest companies, but it was around anyone whose majority position investment strategy was in fossil fuel companies, pipelines, and so forth. So what we were very clear, what we weren't going to be able to do is, if we were in an index fund in a public market, we weren't going to be able to, like an ETF or an index fund, we weren't going to be able to control that there could be 0.1% in fossil fuels. And we were transparent about that. So as of the end of 2021, the 5.3% of our holdings had fallen to 3.7%. I will mention that we got out of all of our public investments. So any funds that we held directly in public companies, we divested in 2020. So that helped lower us down to 2.7. We have since gone back up to 3.7, and that was primarily because our fossil fuel holdings and our private equity markets, in fact, did rise at a higher rate than the rest of the market. So our endowment is now just under $1.5 billion. So we've seen considerable growth. But we're still on our path, which was a 10 to 13 year path to fully divest, to allow the private equity markets to mature, sell them off, and then not reinvest them into fossil fuels. So that's how it worked. I want to be clear, this is our endowment fund. This is not our retirement plan fund. We've yet to tackle that. And our retirement fund is, with TIAA-CREF, and which has a lot of index funds. So we're struggling with how to apply this thinking to that. I will say, since 2018 and since we put it in place, I think the community is pleased with that effort. We have not had any significant backlash. I will say we've probably been able to raise advancement and development dollars for people who supported us in doing it. I'll also add that we received considerable national attention from other schools and university, and President Patton and I have literally been on tour throughout the country explaining how we did it. Investor manages 14 other clients. I will say they're foundations in colleges and universities. The sensitivity around our decision, and there are other schools who have opted out of going into fossil fuels, but they have two foundations in Texas who think differently of the fossil fuel industry. So those are some of the dynamics that we dealt with. It is a journey. The things I would conclude with before opening it up to questions are, it was really important for us not to put the institution at a fiduciary risk. And in retirement plans, it would be the same thing. So that was why the time horizon to get out of the private equity. We made a decision with Investor in 2020 to divest of the public holdings because the fossil fuel industry was at its lowest levels. So we captured those losses at the time. Since then, they've come back. Our critics have criticized us for that. But it was such a small fraction of our endowment. It wasn't meaningful, and we were able to make that case. The second thing I'd call your attention to, we currently now have 15% of the endowment in sustainable investing opportunities, primarily renewable energy. And our board was uncomfortable with not being in the energy sector because even with global warming, even with the changes that are happening, we as human beings haven't been able to decrease our dependency on energy. So if it's not fossil fuel, it has to be something. So it was important for us to build a base of renewable solutions, which we're now invested in and are performing quite well. In 2010, 2013 timeframe, those didn't exist. There wasn't enough of them. There's now becoming more and more available.
Well, David, thank you. This is really helpful. I just want to clarify one thing. I think you said, and I think I understand, that you didn't include any of your retirement funds or any of your indexed funds in the divestment. Is that correct?
Correct. So in our private equity holdings, we basically take a chunk of money. Middlebury puts in $1 million, the other 13 clients put in $1 million, and it's now a pool of $14 million. That goes to a manager, and they choose a manager who invests in private equity funds, advances capital to startup companies, for example. If that startup company chose to put 2% of their money into an index fund, and that index fund actually had a portion of fossil fuel, we can't control that. So we were transparent on that piece. On the retirement plan, it is completely separate. It's not on the balance sheet of the college because it is the assets of the faculty and staff. And so that's about $800 million. And that plan is managed by Tia Kreff. And it is more common to see index funds in a retirement plan than it would be a wealthy college's endowment. So that's what the distinction I was trying to make.
Okay, yeah, that makes sense. And we had a discussion earlier with the Vermont Pension Investment VPIC, Vermont Pension Commission, and the treasurer's office about investment engagement versus divestment. And I'm wondering what has been the strategy of Middlebury in that area? What's your balance between engagement and divestment?
So engagement, meaning from seeking alternative renewable investments or with community members?
Using a vote as a shareholder.
Oh, absolutely. So we explored that in depth back in 2016, 17, working with the students. The students were adamantly against it. Our board members, who are a lot more sophisticated in this space, made that argument that we could have a greater impact. One of the lengthiest debates were there's a belief that the largest fossil fuel companies will also become the largest renewable energy companies because that's where the money is, and and we're starting to see some of that. So we are continuing to push Investor and push our renewable energy solutions to grow. But at the time, we did not take that as a solution of proxies because that was the argument. Let's vote with our money.
Yeah.
to get these companies to change. But at the end, the conclusion was to divest of fossil fuels in the endowment.
Okay, that's helpful. Do you have any one page or two page, short document that sort of outlines how your process, or from a previous presentation, or anything that you could send our way that we could post as on our website as information to get back to if we're trying to remember what you've told us?
Yes, I'd be glad to. I wrote up some notes for this that I just shared with you. I'll send you that, as well as I will reference a 2020 Harvard Business case study that was done on the Middlebury. A graduate class did a case on the Middlebury divestment, which is actually pretty well done, which goes into great detail. It was Harvard Business case in April of 2020. And you can, on the HBS site, you can just put Middlebury College divestment.
Okay, that would be great. Olivia, can you find that?
So did they do it on their own divestment? I want to know. Good question.
Say that again.
Did
HBS do one on their own divestment?
Well, it was funny because at the time, there was a large debate going on at Harvard about this. And so the students who were involved, of course, were very curious for self-interest. But I don't believe they've done one yet on their own investment strategy.
Which they finally did, but after Middlebury.
But it was after, yeah.
Yeah. Senator Clarkson and I have a little competition going, so between Harvard and Middlebury. But so Middlebury's winning. Thank you, David. And we're gonna have to move on, unfortunately, but this has been really helpful, and I really appreciate it, and send my best to everyone in Old Chapel.
Great.
And we'll see you at some point soon, I hope.
Okay, great. Thank you all.
Thank you. This was great.
Thank you, David. Take care.
Yep. Bye-bye.
All right, everyone, we are gonna move to a tiny little bill that hopefully won't take us very long.
Is there such a thing?
Yeah, it really is easy, so.
Oh, this is the Colchester.
Thank you.
And we have our Colchester rep.
Yeah.
Goodbye, Tom.
Thanks
Goodbye,
again.
Gavin.
Thanks.
Thank you.
Tucker, would you like to join us at the table?
Oh, it's just one page.
Wait, did we have, oh, no, I'm sorry, Rep. Taylor, why don't we have, sorry.
It's a tiny little bill.
It is a tiny little bill.
It's not a tiny.
We didn't say it was unimportant. We
It's
said that it is
Nothing is
diminutive in
tiny.
size.
It's a big deal.
It's a big deal, especially to your community, and we appreciate that, and that's why we want to take it up. So, thank you for joining us and for your patience. We're, as you could tell, behind. We were on the floor longer than we had anticipated. We're gonna introduce ourselves because, and to others in the room as well, because you haven't been with us yet. But I'm Senator Ruth Hardy from the Addison District.
Olivia Parker, Committee Assistant. Senator Tanya Vihovsky, Chittenden Central.
Hey, Rebecca White, Windsor County District.
And Watson, Washington District.
And Allison Clarkson, Windsor County District.
So if you want to just tell us who you are and then why we should care about this little bill.
It's a big bill.
I'm Representative Kirk Taylor from Colchester. And I presented this to the House as well, and I should have prefaced it a little bit. I'm sure you're all familiar with municipalities and what they mean, but in Colchester originally, Colchester's a big town in some respect, in most respects. It's population of 17,000. It's 58 square miles. It's a large town. And it had at one point, I hear different numbers, 5 or 6 different municipalities providing water services and fire protection services. Each of them had different and overlapping portions of the town, and they also all kind of coordinated responding to events and things like that. So it was large and complicated, and the select board decided to kind of consolidate and straighten this out. So part of that last session, Colchester Fire District 1 was dissolved. all its assets transferred to Champlain Water District. Champlain Water District has been providing, I'm sure Joe Duncan can talk to you more about exactly with Champlain Water District, but most of these fire districts actually purchased water for their, when I say fire district, they're also handling water, water utility.
Oh, they provide water?
Yes, so they provide fire service and they also provide the water, the drinking water for the citizens. So most of them, Champlain Water District gave them the water and then they transferred it out. I may not be quite accurate, but joking straight.
More or less.
In any event, they most of the services and things like that, they would contract with Champlain Water District. They didn't own a lot of the big trucks and things like this. They just contracted out the maintenance and things like that. So therefore, dissolving them is not as complex as it could be. The fire protection portion of Colchester Water District 3 has already been transferred to the town. The water facilities have already been transferred now to Champlain Water District. For all intents and purposes, Colchester Fire District 3 doesn't exist except as a political and corporate entity on the state.
Yeah.
So that's the preface to my testimony. I also did include testimony to be posted on your website, so you should have that along with a map of the different fire districts. So basically, I will go through my testimony as I send it to you. I do thank the committee of the Senate Committee on Government Operations for the opportunity to present the bill. It's a good opportunity for me to help the Select Board of Colchester get their consolidation done. The purpose of Page 46 is to validate the dissolution of Colchester Fire District Number 3. This is part of Colchester Select Board's plan to consolidate the provision of fire protection and drinking water. Because Colchester Fire District 3 is recognized as a municipality, its political and corporate dissolution requires validation by the state. Last session, Colchester Fire District 3 dissolved for the protection. On July 1st, 2020, so we're going back 2 or 3 years, Colchester Fire District 3 paid off its fire-related debts and liabilities with funds previously provided by the town of Colchester for fire protection services. So they had a budget, they presented it to the town, gave them money, and they're using that now, or they used it then, to pay off its debts and liabilities. And they transferred the fire protection assets to the town. So Colchester is worrying all about the fire protection. Colchester Fire District 3 stopped providing any fire protection services at that time. So that's July of 2020. For the drinking water services in March of 2022, last year, the residents of Colchester Fire District 3, of which I am one, voted 128 to 115 to dissolve the fire district and transfer all remaining assets and liabilities to Champlain Water District. So that's the water structure that they're now.
128 to 115?
A little close.
It's closer than it should be.
Yes,
So
and I'm happy to explain that if you want. I can do
So that was the
now.
water vote?
Excuse me?
That was the water vote?
Yep.
What was the fire vote?
That, I don't believe that there was a vote. I believe that it wasn't necessary for them to transfer the fire protection services to the town, did not require a vote.
Oh, how odd. Okay.
That's my understanding as well.
Okay.
I wasn't involved in that, but that is my understanding.
And I don't remember voting on that, so.
Okay.
As a member of the district. The vote was close, and I'm happy to explain.
Sure, if you have a brief explanation.
My speculation is, and it's not that much speculation, was that fire districts, volunteer fire districts, have a lot of meaning to a lot of people in Colchester and in the state. They're volunteer, people get involved. It's a rallying point. It's a real, there's a lot more involved than just providing the fire districts, the fire protection. So a lot of the members a lot of the people in the district didn't like to see that go, the old volunteer fire district. That had worked for so many years. And they said, well, why should we get rid of it? It's a nice institution, brings the community together and things like this. The trouble was that nobody wanted to be on the Prudential Committee, really. The Prudential Committee is getting older. They've been doing it. They said, we want out. And so that's why the vote was closed, because there were a lot of people who have emotional and cultural attachments to volunteer fire districts. And the hope was that, well, if we retain the water, if we didn't dissolve ourselves completely, and if we didn't get rid of the water, maybe there's a chance we could get the fire back.
You'd already gotten rid of the part that they were
The fire
sentimental
district
about,
part
which is
was
volunteer
gone.
fire.
It was gone.
There was probably also a lot of confusion as to what people were voting on.
Yes,
They were worried they wouldn't have water or fire protection if they voted to do it.
I think you're absolutely right.
Yeah.
Yeah. June of 2022, Champlain Water District executed an asset purchase agreement with Colchester Fire District 3 for the transfer of all the property, assets, and liabilities. So that was done in June of 22. That included all the water system piping, infrastructure, hydrants, valves, meters, a small building, cash deposits, and liabilities, all been transferred. Status: on July 1st of 2022, the asset transfer became effective. Colchester Water District, Champlain Water District has owned and operated Colchester Water District 3's water system since that date. When I get my bill now, it comes from Champlain Water District. The current Champlain Water District Manager, Joseph Duncan, affirms that as of July of 22, all necessary transfers have taken place. The residents of Colchester Fire District 3 now receive fire and rescue services from the town of Colchester. So that's all taken care of, the fire part. Water services provided by Champlain Water District. H46 completes this process with the state validating dissolution of Colchester Fire District 3 as an operational, corporate, and political entity. And that's
Excellent. Well, thank you so much. Are there any questions for Representative Taylor? Senator Watson?
So one hypothesis is that if it was allowed to, like, if we didn't validate the dissolution of it, it would continue, and would the folks who are on, was it called the Prudential Committee? What is it? So I'm not familiar with that kind of committee, but I assume it's sort of like
a board.
It's a board that governs it, right? So they would more or less be obligated to continue to meet and.
Oh, well, that's a good guy. I hate it when people say, that's a good question.
Our ledge council might be able to answer that question.
That might be better addressed.
He's just chomping at the bit.
I guess I'm wondering more generally. So on the one hand, like, this helps kind of clean things up a little bit by validating this and allowing it to dissolve. Functionally, is there any there's no ongoing cost for it to be not functional.
No.
So
there's, as far as I know, there is no Prudential Committee anymore. They're not meeting anymore. They're not.
They're done.
It's gone.
They're done.
Okay.
This is a pretty standard thing, and I know
So
it's the first one we've done, so.
We're gonna do a lot of these.
So I'm down to it.
But, so maybe we'll let Tucker come up and give us the sort of background legally and then,
I'll ask when.
Yeah,
we
so
chat with Joe.
thank you very much. And
Provide some insight
did you
as well.
submit that in writing so that we
Yes,
have it for the
you got
record? It's on.
Thank you.
Thank you
And for
so
whoever
much.
reports this on the floor.
Yeah.
Excuse me?
And for whoever reports it on our floor.
Yes.
That's
Of course, I just read it.
Yeah. Thank you so
Thank you.
much.
Very
right,
much
Tucker.
appreciated.
Feels like you were gonna fall asleep over there.
He needs chocolate.
Yeah,
You too?
we have a little chocolate here. Yeah, I'll stand up some chocolate while we, all right, go ahead.
Good afternoon, Tucker Anderson, Legislative Counsel. H46 has essentially one operative provision, which is to state that Colchester Fire District Number 3 shall cease to exist as a political entity or body corporate on the day that this act is passed and signed. There's recitals before that, but you've gotten all of that background information about when the documents were signed and when this was approved. Some of the legal background, why does this happen? And why is it here? And what would happen if it didn't get passed? The why is that this is the branch of state government that has authority over municipal corporations. And you have the sole authority to create and destroy those municipal corporations. And it's helpful to think of this in terms of they're just another form of corporation. They're an enduring, infinite entity that is not bound to our corporeal beings, right? We invest something into this creature that outlives us. That's how its finances are able to carry forward, even as its officers come and go through the Prudential Committee or through the General Assembly, the House and the Senate. This is an enduring corporation with a charter. Your charter is the Vermont Constitution. In this case, Colchester Fire District Number 3's charter are the statutes governing fire districts, which allow them to be created by the voters, but do not provide for dissolution. So then the question is, well, then why not? And the answer is that these corporations are allowed to exist, exercise authority, and of course, acquire debt on behalf of their voters. And when they are dissolved, creditors cannot go after that debt when the legislature waves its magic wand and erases this corporate being. So that's what you're doing with this bill. You are erasing this corporation from existence. If you didn't, the corporation would still exist, whether or not the Prudential Committee is being elected or appointed, or however they fill that board, and meeting in a physical meeting location. The powers of the fire district would still exist. The duties and obligations and statute would still exist, and this corporate creature would go on indefinitely until it gets formally wound down and dissolved. From a practical standpoint, the winding down of the corporation has taken place.
Yeah.
There are legal instruments that have transferred assets and liabilities to another corporation. However, if you don't dissolve this Fire District Number 3, and the Prudential Committee all of a sudden decided to get together again, they could hold a bonding vote or exercise statutory authority. So that's why this is here. And in the past, Representative Taylor did a fantastic job of walking through some of the documents and providing evidence. That's what the government operations committees in the House and the Senate have done. They have gone through essentially an evidentiary packet to make sure that by dissolving the corporation, you're not leaving a creditor or a litigant, right? What if someone was suing this corporation right now because of some wrong and they needed damages? By erasing the corporation, you erase the opportunity for that person to get healed by the legal system for any wrongs done to them because they have no one to sue.
And are there any outstanding issues like that that we should be aware of or concerned about in this case?
Not that I'm aware of.
Okay. Does that answer your question, Senator Watson?
It sure does.
Okay.
Thank you.
And I live in a small town of East Middlebury that has a fire water district. And we have a Prudential Committee of 3 people, and they have to meet annually, and they have duties, and it's like our little select board, even though we are part of the town of Middlebury. We have our own little Prudential Committee, and we have better water and cheaper water than the town of Middlebury. It's different water because we have a different water district. Yeah, so lots of like these weird little like old things that have lasted for hundreds of years.
And I'm sure it's as prudent as its name.
It is very prudent. It's prudent, yes. Senator White.
Thank you, Madam Chair. What would be your hopeful timeline on passing this bill out of our committee?
We are going to pass it out tomorrow.
I was gonna make, yeah, I was like, I'm ready to make a motion.
Well, generally, one doesn't want to pass out a bill, just in case somebody jumped up and said, you know, oh, wait, this
There is
fire
that.
district owes me something. I want to give them one day to be able to do that. So
Great,
we'll
thank you.
pass it out tomorrow.
That's what I appreciate.
Tucker, you don't need to come back unless we ask you to, but we are gonna, we're gonna hear from one more witness. And Joe Duncan. And thank you, Tucker.
Are you wearing a vest? Are you wearing a rah-rah vest that says Champlain Water District on it?
We're proud of what we do.
Yeah, they already have vests. So if you want to just
Comes with the
introduce yourself to the committee.
I am,
Tell us what you think we should know about the situation.
Absolutely. I'm Joe Duncan. I'm the general manager with Champlain Water District. And as Representative Taylor indicated, we are a water supplier. We're technically a wholesale water supplier, which means that we sell water to communities within Chittenden County. We sell it to 12 water systems in 8 communities within Chittenden County. Pretty much kind of everywhere except for Burlington. They have their own water supply source. And so our mission is essentially to get water to the community, and then the community uses their own infrastructure to get that to their end users. And so, but as Representative Taylor has indicated, we actually have some contract services that we provide in addition to the wholesale services where we will do contract operations for systems. Started with South Burlington, which was originally the idea when we formed was to possibly have CWD be the operator of systems. South Burlington was really the one that gravitated towards that. Village of Jericho would do that as well. Colchester is an interesting beast. We've done operations in there for many, many years, but there's been some other odd pieces there. And to kind of fill you in, and please, in the interest of time, if you don't want to hear any of this, please tell me, I'll jump right to questions or whatnot. Because I respect it's probably been a long day. So Colchester, back in the 60s, had no fire or water service. The communities were calling for water and fire service to be provided. The town of Colchester, for whatever reason, the select board had no will to take that on. So the entities around the town, and as Representative Taylor said, Colchester is a large community with many different areas. You have the St. Michael's College area, which you have the village area, kind of Route 2A and now 7 come together. You have Mallett's Bay Ave, and then you also kind of have the exit 16 area that's there. And so what happened was fire districts were born. They decided to break it up into fire districts, create individual municipalities within the large municipality of Colchester that had its own rights and operations similar to East Middlebury Fire District. Fire 1 was St. Mike's area. Fire 2 was Mallett's Bay area. And Fire 3 was basically everything else, exit 16 all the way up to the Milton border out to the Sandbar. Well, not quite Sandbar, it's Milton's there, but up towards that area. So, and they were run for many, many years. Fire 1 was run by a bunch of the Edmundite priests at St. Michael's College for many, many years.
Well, some priesthood jam, why not?
Yeah. So but their fate was that they had basically a couple champions, Edmundite priests that stayed on, ran the fire district, had the Prudential Committee meetings. Essentially, the Prudential Committee meetings were probably very similar to what might happen with you. The 3 members show up, with a treasurer and a clerk, and that's all the people, and plus us, because we would run their system. That's pretty much anybody that would ever show up in any of their Prudential.
They bring
meetings.
cookies just to try to lure people in.
Yeah, never worked. But so Fire 1 got to the point where 2 of those leaders in there became aged enough. They were 85 and 78, I think. So they got to the point where they couldn't run it anymore. They had a couple younger.
Responding to fires too.
No, this is the Prudential Committee. So the organization that actually runs it. Interestingly enough, in Colchester Fire 1, St. Michael's College runs the fire and rescue. And so it's actually a private organization that runs the fire in the Fire 1 area through St. Mike's. And it's actually still in existence today as part of the transition of fire department to Colchester. The town of Colchester still contracts with
a nonprofit, you mean, by private nonprofit?
Yeah, private nonprofit, yep, exactly.
So you supply all the water now to all the places in Colchester, and then fire department is the town,
Yeah.
and the St. Mike's Fire. Okay.
To be clear, one other piece is Fire 2 is Mallett's Bay. And Mallett's Bay gets their water from Burlington, and their prudential committee is strong. They've got a very good group of people that are willing to step up and run it. So managerial capacity is really the issue that's here. Because we always provided for Colchester Fire 1 and Colchester Fire 3, we provided the operational capacity. And so they got to a point where no one was willing to step up to run it anymore. And they said, no one wants to step up. We don't want to do it. What are we going to do? So we actually own 2 systems in Colchester because in the 80s, they were built by private individuals. They said, we can't do this anymore. Water quality was becoming a concern. Fire 3 wouldn't take them over. Town of Colchester had no interest in taking over. So we stepped in and said, we'll take it over and we will give you, our goal is to give it to the town. And that was back in 1990. So Fire 1 came to us and said, will you take us over? We took it over. We said, great, maybe we can give these 3 to the town. Fire 3 came along and said, we can't do this anymore. Will you take us over? We said, yes. Now the town is actually interested in taking over this larger group of water systems. We're actually going to combine it and give it to the town.
Are you a municipality, or are you?
Yes.
Yeah, okay, all right. Well, cool. This has been
There you go.
enlightening. It sounds like all the i's are dotted and t's crossed.
Also to put on record, we have inherited all of the debt for Colchester Fire
I was
District.
gonna say, we're inheriting the assets out of the debt.
Yes.
And what was the amount of?
Great.
The amount of the debts in the, I can provide that to you outside of this, but it's in the several millions of dollars of debt, either through drinking water SRF or bond.
Okay.
Upgrading pipes. and-
Yes.
Yeah, great.
Thanks.
Go ahead, Senator.
So, Joe, I just want to be clear on this. You're telling me, I mean, surely Colchester had water before 1960s when they said, who laid the pipe? I mean, who put all the infrastructure in? It must have been in the early 20th century.
There were a variety, you might know better than I do. There were a variety of like private lines that kind of went in different places.
Kidding.
Um,
Was never done as a community.
St. Mike's was called Winooski Park, and Winooski Park, which was St. Michael's College, essentially bought their water from Winooski.
Infrastructure in Vermont has always been really patchwork and not cohesive, and this is a great example of it.
Yeah, it sure is.
And some cases that makes it really wonderful, like local initiatives and volunteers and everything, and then it also makes it really complicated and problematic in some ways. Anyway, well, Joe, thank you so much for sharing that information. We are gonna vote on the bill tomorrow. We'll just give it one day to sit on our agenda just in case. But I doubt there'll be any problems. Senator Vyhoski's gonna present the bills because she has a little bit of Colchester in her district.
I believe my district is fire district number 1.
Yeah.
Regardless, it's still yours. And thank you for your time today. I appreciate it.
Thank you. Thanks for having us.
We can go offline.
Interesting.